There is a $1.5 trillion market that most retail investors have never heard of. And yet, pieces of it are quietly sitting inside your retirement account right now. I spent the last 72 hours pulling filings, tracking fund flows, and mapping a structure that Wall Street spent 30 years perfecting. And what I found raises three questions that nobody in financial media is asking. First, who benefits if this market reprices violently during a recession? Second, what is the real trigger that smart money is watching? Because it is not the headline default rate everyone quotes. And third, what hidden metric buried inside CLO structures tells you whether your so-called safe yield is actually safe or whether it is a ticking clock? By the end of this video, you will understand exactly how leveraged loans work, why they are suddenly showing up in ETFs marketed to everyday investors, and the specific warning sign that institutional players use to exit before the headlines catch up. The number that stopped me cold was this. As of late 2024, default rates on U.S. leveraged loans climbed to 7.2%, according to the Financial Times, the highest level since the end of 2020. But if you pull up most financial news, you will see a completely different number, something closer to 1%. That gap, that 6 percentage point difference, is not a rounding error. It is the key to understanding everything that follows. And there is a specific date I want you to remember: September 2024. A company called First Brands, a manufacturer of automotive brakes and parts, went from carrying a single B credit rating to filing for Chapter 11 bankruptcy in less than 2 weeks. Its loans were priced above 90 cents on the dollar at the start of the month. By month end, the company was in court. That speed, that violence, is what happens when covenant light meets refinancing stress. We will come back to First Brands because it reveals something that changes how you should think about every yield you see in this market. Let me walk you through the evidence board. I have 5 cards to show you today. The first is the headline story, what leveraged loans actually are and why they exist. The second is a filing reality check. What happens when you dig into the actual documentation of these loans? The third is a macro metric that nobody talks about, the covenant light phenomenon that has consumed over 90% of this market. The fourth is a market anomaly, the strange fact that CLO ETFs have exploded from $2.25 billion in assets in 2023 to over $20 billion today, a nearly tenfold increase in less than 2 years. And the fifth is a historical echo, because we have seen this exact pattern before, not in mortgage-backed securities like 2008, but in a quieter corner of corporate debt that blew up in 2001 and again in 2015. But here is what makes this different. This time, the risk is being actively marketed to your 401k. Let us start with the surface story. A leveraged loan is essentially a loan made to a company that already has a lot of debt. These are not blue-chip corporations with pristine balance sheets. These are companies rated below investment grade, often backed by private equity firms that loaded them up with debt during a buyout. Think about it this way. A private equity firm wants to buy a company worth $1 billion. They might put up $300 million of their own equity and borrow $700 million through a leveraged loan. The company, not the private equity firm, is responsible for repaying that debt. The loans are called senior secured, which sounds safe because they sit at the top of the capital structure and are backed by collateral.
If the company goes bankrupt, senior secured lenders theoretically get paid first.
They have a claim on the company's assets, its real estate, its equipment, its intellectual property. That is the pitch. That is why these loans have been sold as the safe way to earn high yields in a low-rate world. And for most of the last decade, the pitch worked. Leveraged loans delivered consistent income with relatively low volatility compared to high-yield bonds. They became a staple in institutional portfolios. But here is where the story gets complicated. These loans do not sit quietly on bank balance sheets anymore. In the 1990s, Wall Street figured out a way to package them, slice them into tranches, and sell them to investors who wanted different risk and return profiles. The vehicle they created is called a collateralized loan obligation, or CLO. You can understand this in 30 seconds. Imagine a manager buys 150 to 200 leveraged loans from different companies. They pool those loans together, then issue bonds against that pool. The bonds are divided into layers. The top layer, rated AAA, gets paid first and earns the lowest yield, but has the most protection. The bottom layer, the equity tranche, gets paid last but earns the highest return if everything goes well. In between, you have AA, single A, triple B, and double B tranches, each with progressively more risk and more yield. The magic of this structure is subordination. Losses from defaulting loans hit the equity tranche first, then triple B, then single A. The triple A tranche only takes losses after everything below it has been wiped out. Historically, over 70% of loans in a CLO would have to default before the triple A tranche loses a single dollar. For context, the peak default rate during the 2008 financial crisis was 12%. So on paper, AAA CLOs look bulletproof. In fact, no AAA-rated CLO has ever defaulted in the asset class's 30-plus year history. That is the statistic you will see in every marketing document. That is the line that convinced pension funds, insurance companies, and now retail investors through ETFs to pour money into this market. But that statistic hides something important, and this is where we open the first door. Remember that question, who benefits if this reprices? The answer starts with understanding what default actually means in today's leveraged loan market. The official default rate tracked by agencies like Standard & Poor's measures what is called payment default, when a borrower actually misses a scheduled payment or files for bankruptcy. As of late 2024, that rate was hovering around 1 to 1.5%. Sounds low, sounds safe, but there is another category that has exploded in recent years: liability management exercises, or LMEs. These are transactions where a distressed company restructures its debt outside of formal bankruptcy. Maybe they extend maturities. Maybe they exchange old debt for new debt with different terms. Maybe they move collateral around to favor one group of lenders over another. These are not technical defaults in the traditional sense. The company keeps paying something. But for investors holding the original loans, the economic outcome can be nearly as painful as a bankruptcy. Recovery rates are lower. Protections get stripped. And yet, because it is not a formal payment default, it does not show up in the headline number. When you include LMEs and distressed exchanges, the real default rate in the U.S. leveraged loan market climbs to somewhere between 4 and 7%, depending on which measure you use. PitchBook data shows that at the peak in July and February of 2025, LMEs comprised 73% of the default landscape.
In January 2020, at the start of the pandemic crisis, LMEs were just 9% of defaults.
Let me say that again. Nearly 3/4 of defaults are not even being counted as defaults in the headline statistics. This is the metric that smart money watches. This is door number 2. The real trigger is not whether companies are missing payments. The trigger is whether the entire definition of default has been engineered to hide stress. And this brings us to evidence card number 3, the covenant light phenomenon. If you follow this channel, you probably know that covenants are the protective clauses in loan agreements that give lenders power. Traditional covenants might require a company to maintain a certain debt-to-earnings ratio, or restrict how much additional debt they can take on, or limit dividend payments to shareholders. If a company violates these covenants, lenders can accelerate repayment or force a restructuring on favorable terms. Covenants are the early warning system. They are supposed to flash red before a company spirals into distress. But here is the problem. According to PitchBook, over 90% of the broadly syndicated loan market is now covenant light. These loans have stripped out most or all of those protective clauses. Even in private credit, which was supposed to offer better lender protections, fewer than 10% of loans above $500 million include maintenance covenants. Some analysts are calling this the shift from covenant light to covenant void. The University of Bath published a study that found highly leveraged loans are increasingly underpriced, particularly among non-bank lenders not subject to the same regulatory oversight as traditional banks. The researchers warned that this pricing distortion reflects structural weaknesses in the post-2014 leveraged lending landscape. The shift to non-bank credit origination, rapid growth in CLO issuance, and declining loan standards have converged to create what they called a dangerous environment, where systemic risks may go unrecognized until a crisis emerges. According to the IMF, over one-third of borrowers in the leveraged loan market are already cash flow negative. They are surviving not because their businesses are thriving, but because the structures allow them to keep rolling debt and deferring problems. Drop a comment below with one word: protected or exposed. Based on what you have heard so far about covenant light loans, which word describes how you feel about your own fixed income exposure? Now let us talk about evidence card number 4, the strange explosion of CLO ETFs. For most of the CLO market's history, these instruments were exclusively institutional. You needed millions of dollars and sophisticated infrastructure to access them. Banks, insurance companies, pension funds, sovereign wealth funds. That was the buyer base. But starting in 2020, something changed. The first publicly traded CLO ETF launched, giving retail investors a way to buy baskets of CLO tranches through a regular brokerage account. At first, adoption was slow. But then came the hunt for yield. With Treasury yields still relatively low and inflation eating into real returns, investors started looking for alternatives. CLOs offered floating rate exposure, meaning their yields adjust upward when interest rates rise. They offered credit risk without duration risk, which is exactly what you want in a rising rate environment. And the marketing was compelling. AAA CLOs yielding 6.5% with no 30-year history of defaults? For a retail investor, that sounds like free money. By 2023, CLO ETF assets had reached about $2.25 billion. By the end of 2024, they had surpassed $20 billion, a nearly tenfold increase. The Janus Henderson AAA CLO ETF alone now holds over $6 billion in assets and dominates over 70% of the US AAA CLO ETF market. It won the 2025 ETF.com Active ETF of the Year award. Deutsche Bank noted that CLO ETFs are now showing up in 401k accounts and IRAs. The global ETF market is valued at around $14 trillion, and CLOs are no longer a niche product for hedge funds. They are being positioned as a core fixed income holding for everyday retirement savers. In July 2025, Reckoner Capital Management launched the first leveraged CLO ETF. Not just a CLO ETF, a leveraged CLO ETF. It uses up to 50% leverage on top of AAA CLO positions to juice returns. This is the kind of product that appears at the end of cycles, when investors are so desperate for yield that they will add leverage to already complex credit structures. But here is where I need you to slow down and think about door number 3. What hidden metric tells you whether your safe yield is actually safe? The answer is the distress ratio. This is the percentage of loans in the CLO universe that are trading below 80 cents on the dollar. When a loan trades at a deep discount, it signals that the market expects problems. Maybe a restructuring, maybe a default, maybe an LME that will impair recovery. As of late 2024, the distress ratio was hovering around 5%, down from earlier in the year, but still elevated compared to historical averages. And here is the nuance. The headline distress ratio only captures loans that are already trading at distressed levels. It does not capture loans that are about to cross that threshold. It does not capture the shadow stress building in covenant-light structures where lenders have no early warning system. According to Fitch, over one-third of borrowers in the private credit market are already cash flow negative.
They are surviving on asset sales, delayed payments, and creative accounting. The Federal Reserve has highlighted that banks have extended $95 billion in committed credit lines to private credit funds,
creating a feedback loop where risk is amplified rather than contained. When we come back to this point later, you will understand why that $95 billion number changes everything. I track credit markets weekly on this channel because the signals often show up months before the headlines. If you want to see the next piece of this puzzle before it becomes obvious, the notification bell is your edge. Let me show you evidence card number 5, the historical echo. This is not the first time Wall Street has created a complex product, stripped out protections, marketed it as safe, and watched it blow up in a downturn. In 2001, the telecom bubble burst and high-yield defaults spiked. CLOs existed back then, but the market was smaller and documentation was tighter. Losses were contained. In 2008, the crisis was different. Collateralized debt obligations, or CDOs, were the villain. CDOs were similar to CLOs but often backed by mortgages instead of corporate loans. The key difference is that mortgage borrowers are individuals who can simply walk away from underwater properties. Corporate borrowers are companies with ongoing operations, cash flows, and tangible assets. CLOs performed relatively better during the financial crisis. AAA CLO tranches saw price drawdowns of around 10% using daily returns, similar to other short-duration markets. But BBB CLO tranches dropped 30%, more than BBB corporate bonds, and comparable to high-yield corporates. The market recovered, lessons were supposedly learned, and CLO 2.0 was born. Post-crisis CLOs have better structural protections, more diverse collateral pools, active management, and shorter reinvestment periods.
At least that is what the pitch deck says. But here is the historical rhyme that concerns me. In 2015, oil prices collapsed and energy sector leveraged loans got crushed. Default rates spiked, the distress ratio jumped, and for a moment, the CLO market seized up. Spreads blew out, liquidity vanished. It was a stress test, and while the market did not break, it showed cracks. Energy loans went from being a core holding to being toxic in a matter of months. Managers who were overweight energy saw their performance collapse, and it happened fast, faster than most investors could react. Now layer on today's dynamics: 90+% covenant light, 7% effective default rates when you include LMEs, retail money flooding in through ETFs, and a macro environment where the Fed is cutting rates, which sounds bullish until you realize that rate cuts often signal that something is breaking. The Fed does not cut rates when the economy is strong. They cut when growth is weakening, when unemployment is rising, when something in the system needs support. The Skeptic Corner. I promise to give you the strongest argument against this thesis, so here it is. AAA CLOs have structural protections that make them genuinely different from the subprime CDOs of 2008. The subordination is real. 70% of underlying loans would have to default before AAA takes a loss. That has never happened. Even in the worst crisis scenarios, AAA CLOs have held their value far better than comparable credit products. Furthermore, CLO managers actively trade their portfolios. If a loan starts deteriorating, they can sell it and replace it with something healthier. This active management is a genuine advantage over static pools. And floating rate exposure means that as the Fed cuts rates, loan yields will adjust downward, but so will borrower interest costs. Lower rates are actually positive for leveraged loan fundamentals because they reduce the debt service burden on borrowers. Interest coverage ratios improve, free cash flow improves, default risk actually goes down when rates go down, all else equal. The counterargument is strong. I want to be honest about that. But here is where that objection becomes a clue. The very fact that AAA CLOs have never defaulted creates a dangerous dynamic. It encourages investors to treat them as risk-free when they are absolutely not risk-free. It creates complacency. It attracts money that would never have entered credit markets a decade ago. And most importantly, it creates concentration risk. Over 60% of the US leveraged loan market is now held by CLOs. That means the same vehicles that are supposed to absorb losses are also the dominant buyers propping up prices. If CLOs ever become forced sellers, whether due to redemptions, covenant tests, or manager distress, there is no natural buyer at scale. The market is holding up its own pants. This is the moment we return to door number 1. Who benefits if this reprices? The answer is complicated, but let me give you the map. First, private equity sponsors benefit from the current structure because covenant-light loans give their portfolio companies maximum flexibility. They can lever up, extract dividends, and delay restructurings. As long as the music plays, sponsors collect fees. The average private equity fund charges 2% of assets and 20% of profits. They have every incentive to keep portfolio companies alive and paying, even if that means kicking problems down the road through LMEs and distressed exchanges. Second, CLO managers benefit because their fees are based on assets under management. The more money flows into CLO ETFs, the more CLOs get created, the more management fees get generated. There is an incentive to keep the machine running. Third, distressed debt investors benefit when it breaks. There is an entire ecosystem of hedge funds and special situations investors who specialize in buying assets at 50 cents on the dollar after a dislocation. They need volatility, they need stress, and they are patient. They are not trying to prevent a repricing. They are positioning to profit from it. Some of the smartest investors in credit markets are quietly building cash positions and waiting for opportunities. Retail investors are the marginal buyer at the top. Institutional money has been in CLOs for decades. They understand the risks. They have the infrastructure to trade out of positions when signals flash. The money flooding in through ETFs is largely retail money chasing yield in an environment where savings accounts pay less than inflation. When retail investors are the price setters at the margin, that is usually a late cycle indicator. I want to show you something that connects back to what I mentioned earlier, that $95 billion in bank credit lines to private credit funds. This is the shadow leverage that most people miss. A CLO is already a leverage structure. You take a pool of loans, you issue debt against them, and the equity tranche is essentially a leveraged bet on credit performance. But private credit funds that feed into the CLO ecosystem often have their own leverage. They borrow from banks to fund loan purchases. They use repo facilities and credit lines to juice returns. So you have leverage on top of leverage on top of leverage. In a stress scenario, this creates a cascade. Borrowers default or restructure. Loan prices drop. Private credit funds face margin calls on their bank credit lines. They have to sell into a falling market. Their selling pushes prices lower. CLO managers see their portfolios deteriorate. Triple B and equity tranches start taking losses. Retail investors in CLO ETFs see their NAV drop and start redeeming. More selling pressure. More price declines. This is not a prediction. This is a mechanism. Understanding the mechanism does not tell you when it triggers, but it tells you what to watch for. Let me give you the two metrics that matter most. First is the distress ratio, the percentage of loans trading below 80. When this starts climbing above 8 or 9%, stress is building. Second is CLO ETF flows. If you see sustained outflows from products like the Janus Henderson AAA CLO ETF or the BlackRock AAA CLO ETF after a period of inflows, that is retail capitulation. That is the signal that the marginal buyer has become the marginal seller. Now here's the piece that is not priced in. In August of 2025, President Trump signed an executive order titled Democratizing Access to Alternative Assets for 401k Investors. This order directed the Department of Labor and the SEC to review regulations that restrict retirement plans from investing in alternative assets, including private credit and CLO structures. The stated goal is to give everyday Americans access to the same investment opportunities as wealthy investors. The practical effect is to funnel more retail money into precisely these complex, illiquid, late-cycle credit products. The timing is notable. We are at peak complacency in credit markets. Spreads are near all-time tights. Default rates look low if you ignore the LME loophole. And the policy response is to make it easier to push retirement money into leveraged loans. This is not a conspiracy. This is just how cycles work. At the top, everyone finds reasons why this time is different. At the bottom, everyone remembers the risks they forgot. Comment below with 2 words and 1 reason. What do you think the biggest risk in CLO markets is right now? Is it default rates? Is it covenant-light terms? Is it retail flows? Or is it something else entirely?
I read every comment, and the best ones make it into future research.
Let me pull back now and show you what I call the master key. This is the simple formula that explains everything we have discussed. Here it is. Official default rates are meaningless without adjusting for LMEs and covenant erosion, and the marginal buyer in any credit market determines the price at which stress gets liquidated. That is it. That is the entire thesis in one sentence. The official 1% default rate is a fiction because it excludes 73% of actual credit stress events. And the $20 billion that has flooded into CLO ETFs over 2 years represents retail money that will be the first to panic when NAVs drop. Smart money knows this. That is why they are selling loans to CLOs rather than holding them. That is why private equity sponsors are refinancing as fast as they can. That is why bank credit lines to private credit funds have reached $95 billion. Everyone is positioning for the pass, not the catch. Remember First Brands, the automotive parts company I mentioned at the beginning? The one that went from single B rated to bankrupt in 2 weeks? That speed is the future. In a covenant-light world, there are no early warnings. No tripwires that force restructurings before companies spiral. By the time a problem becomes visible in the headline default rate, the losses have already happened. The distressed exchanges have already stripped value. The equity has already been impaired. First Brands added 32 basis points to the default rate and placed 4 facilities into default across US and European loan indices. Investors who were overweight relative to their benchmark at the start of September took significant losses before they could react. That is not an outlier. That is what covenant-light plus floating rate plus concentrated ownership produces. Fast, violent repricing with no warning shot. Remember at the beginning of this video I mentioned a strange number buried in the data? I said default rates climbed to 7.2% in late 2024, but most news quoted 1%. That gap is the tell. It means the people reporting the numbers and the people actually experiencing the losses are looking at completely different pictures. If you are a retail investor in a CLO ETF, you are relying on the 1% number. If you are a distressed debt fund, you are trading the 7% number. When those two realities collide, the repricing is violent. The question is not whether leveraged loans are risky. They are. The question is not whether CLOs can blow up. The BBB and equity tranches absolutely can. The question is whether you understand what you own, and whether the yield you are earning compensates you for the risks you cannot see. AAA CLOs yielding 6.5% sounds attractive until you realize that the floor beneath you is held up by 90% covenant-light loans, a distress ratio that is higher than it looks, and a retail investor base that has never experienced a credit cycle. According to Moody's, speculative-grade defaults are expected to decline over 2025 to reach 2.6% in the US and 2.7% in Europe. That sounds reassuring until you remember they are measuring payment defaults, not the LME-adjusted reality. The private credit default rate, according to Fitch, climbed to 5.7% by early 2025, up from essentially 0 in 2022. This is private credit's first big test, a rising tide of defaults and workouts that will reveal how robust the asset class truly is. This is why I build these investigations every week, not to tell you what to buy or sell, but to show you the map that institutions use to navigate these markets. Next week, I am going to dig into what happens when private credit meets the commercial real estate refinancing wall that hits in 2026. Over $2 trillion in commercial mortgages mature in the next 18 months. If you want to see how these two stories connect, make sure you are subscribed because that video will drop before most analysts have even started their research. So where does this leave us? Leveraged loans are a legitimate asset class with a real function in the financial system. They provide capital to companies that cannot access investment-grade debt markets. CLOs are a legitimate structure that has genuinely improved since 2008. The subordination works, the active management helps. AAA tranches have an excellent track record, but the marginal dollar flowing into this market today is not sophisticated institutional capital. It is retail money chasing yield in ETFs, money that does not understand covenant-light terms, money that does not track LME adjusted default rates, money that will panic when NAVs drop 5%. And the policy environment is actively encouraging more of that money to flow in through retirement accounts. When you see complacency at the top, complexity in the structure, and retail as the marginal buyer, you have the ingredients for a repricing event. Not a crash, not a collapse, but a moment when the 7% reality catches up to the 1% narrative. And when that moment comes, First Brands will not be an outlier. It will be the template. Once you understand this mechanism, you start seeing it everywhere. In high-yield bonds, in private credit, in the commercial mortgage market. It is the same playbook with different labels. Complexity to hide risk, yield to attract capital, retail to absorb losses. This is not financial advice, it is education and pattern recognition. Once you see where the risk is hiding, you cannot pretend it does not exist.
The question is what you do with that knowledge. You can understand the full picture in 30 seconds. The leveraged loan market is $1.5 trillion in size. Over 90% is covenant light. The official default rate is 1%, but the real default rate, including LMEs, is closer to 7%. $20 billion of retail money has flooded into CLO ETFs in 2 years. Private credit funds have $95 billion in bank credit lines creating hidden leverage, and policy is actively pushing retirement money into these structures. That is the map. The 3 doors we open today give you the framework. Door 1. Private equity sponsors, CLO managers, and distressed funds all benefit from the current structure and its eventual repricing. Door 2. The real trigger is not payment defaults, but the LME loophole that hides 73% of credit stress. Door 3. The distress ratio and CLO ETF flows are the metrics that will flash red before headlines catch up. Keep watching those numbers. When the distress ratio breaks above 8% and CLO ETF flows turn negative, the repricing has begun. Until then, the music keeps playing. But now you know where the exits are.